All right, folks, welcome back. A little bit earlier broadcast today. I have some plans this evening, so I want to get it out of the way. All right, so we're looking at, obviously, a hindsight view of something I pointed to before it happened. So that way you guys got a chance to see what it was like for my private mentorship group. When I say these things, it's almost like an invitation for some of you to email me to ask to join that. You can't join it, okay? I'm teaching mentorship on YouTube, okay? So that way you don't need to reach out to me, okay? I'm teaching right here, and you didn't have to send me any credit card information. You didn't have to set up any kind of PayPal account. There's nothing to worry about. You either watch it and enjoy it and get something from it, or you never come back and watch it anymore. Okay, it's very simple. But I'm getting a lot of feedback from the comments, and it's been very positive, so I thank you for that. It's very encouraging. All right, so we're looking at the E-mini NASDAQ futures contract for the March delivery. If you remember, I was outlining this imbalance in here, okay? And I gave you the high of this candle, the low of that candle, which it should be sitting right on that. So with this imbalance, we traded down to a discount, back up to a premium. Again, measure the high to the low, and I'll do that for you now because I know some of you are like, can you just do it for me? All right, so here's 50%. That's equilibrium inside this dealing range high and low. So we traded from these lows up into a premium above 50%. Below 50% is a discount. Up here we tried to rally up above this high, failed, broke back down below 50%, and then created a gap. Okay, so it comes up back into a premium market above 50% and fills in the gap. I mentioned how this type of retracement can lull traders into likely thinking it's going to go higher, but we're thinking down here. Okay, the liquidity resting below here is what they're going to attack. So all of this consolidation just sets up another selling opportunity to run down there. And again, you're welcome to go back and listen to the previous discussions, and you'll hear me basically say that we're going down here. All right, so it needs to rebalance this first, and it spends 3 days in that range. Notice that? Then it releases to the downside, attacks the sell side here, and trades into the sell side liquidity resting below here. So let's go into a lower time frame hourly chart and ferret out some more information and details. All right, so here is the hourly chart, and you can see that high end of the fair value gap and the low end of the fair value gap. We traded up into that, sold off, consolidated, sold off once more, and you watched me share on the community tab my live trades from yesterday. It was traded through TD Ameritrade. It was not a demo account. Okay, so I want to go into what I used, what I saw, and then obviously I'll show you in the account where the details were. Okay. All right, so the market started trading, rallied up, took out a short-term high on Friday. See that? Then started the breakdown. Now, overnight, I was watching this, but I was hoping that it didn't take out that low before the morning. I wanted to see it trade up here, take that high out, and then consolidate after running below that short-term low. I didn't want it to be in a hurry before the New York session in the morning, because that would have set up a nice short up here where I could have taken a run under this low and then see if I can capture a re-entry, which is the entry you'll actually see me do, and then the drop down in here. Now on Monday it was a bank holiday, and trading stops at 1 o'clock in the afternoon on holidays generally, and then resumes around 6 o'clock in the afternoon New York time. And where we stopped here, we had already moved aggressively lower and stopped right there. So I felt very strongly that we were going to gap down below it, and it gave just a beautiful gap lower and run immediately. But I was looking at the 13,590, 13,586 level real time, and I couldn't get to my screen fast enough to close it out there. And I didn't want to put a limit order in, because if it gapped really far down below it and started running, really lower with a lot of speed and such, I didn't want to limit my profitable exit with having a limit order in. So I just left it open-ended, and I wanted to see how far it would reach down in there. By the time I closed the trade, it closed me at 13,612 and a quarter. So my entry was 13,858 and a quarter. The exit was 13,612 and a quarter. That's not a little bit of ticks, okay? 240 some plus handles. So you take that 240 some, times that by 4. There's your tick value for those that like to keep counting that. You're going to drop down into a 15-minute time frame. All right, so we had that run on Friday's high here. Started the breakdown, and at 10:30 in the morning, 10:33 was the actual fill. So it's right in that candle, right in here. I'm trading in that candle going short. So we're going to go into the details and look at why that was the case. And again, you'll see the live account log in the business. Okay, so just hold on to your horses if that's the attitude you have right now. Oh, you in the hindsight. So we're going to go into a 5-minute chart, start going down into the details here. Make this a little bit taller so that way you can appreciate the imbalances that are being shown. All right, so we had this rally up, which in my mind was acting like a Judas swing in the morning. Okay, so here's 8:30. It starts to run higher. So I want to be in going short at this candle's opening. And you can see that, well, maybe you can't see it. The opening price over here, okay? Here is 8:30's candle right there. The opening at 13,798.5. So I want to be preferably going short something above that price. Okay, so I'm anticipating further weakness. And before I go any further in this one, I got several people, probably about half a dozen or so, mentioning their confusion with why I mentioned the opening price at New York at midnight and then the opening price at 8:30 in the morning. There's two reference points being specifically dealt with there. If you're looking at the entire daily range, you're going to use the opening price at midnight. But if you're going to be looking at the morning session, you're going to be looking at the 8:30 in the morning opening price. Okay, so hopefully that's made a distinction there. Don't worry, I have a market structured lesson coming up on Thursday that will further solidify and remove all doubts and concerns about that, okay? But for now, let's just go through this one. So 8:30 in the morning, that opening price, I'm bearish. I'm thinking we're going to go down below that green level there. That's the old daily low. So on this candle here at 8:30, I'm expecting all this being a fake rally. It's something to lull in traders to chase it going higher. The retracement, people that don't really understand order blocks, they're going to say, look at that, it's a down closed candle. I'm going to buy that. And then when it starts to go up like that, they feel, wow, this is really easy. Every down closed candle after a run up is a bullish order block. It's not. In here is the real context. Okay, we have an imbalance there. And that's what I'm looking at. I'm looking at this imbalance right there. So I'm trying to operate inside of that range for a short. Now, I know because of the volatility, it can color outside the lines, and it's okay. The bodies of the candles are kind of supporting the idea of what I'm looking for, but the wicks I could care less about because I want to get in when it's ideal. And I'm going to show you what that was looking like for me at the time. So we're going to drop down into a 4-minute chart. Okay, so here is that imbalance and fair value gap on the 5-minute chart, but now it's a little skewed because it takes up 2 candles to show that range. The market trades up, and right in that candle, that one right there, that's where I'm going short. I got in at 10:33. Okay, that was my short. Dropping down into a 3-minute chart. Okay, the market trades up, works inside that imbalance, and right there, 10:33, that candle when it's starting to bump up against the top end of that fair value gap, right there, as it hits that and starts to move away, I'm in there. I'm going short right there. The reason why I'm trusting that and not thinking it's going to go higher is because we have this high here, okay? And then we have this high here. Which high is higher? This one or that one? Obviously this one. Now, this candle's high. Watch what happens. From this high, we have a short-term swing high next to it here, and then we have one here. So this one makes a intermediate term high. So we have a long-term intraday on a 3-minute chart, which sounds like an oxymoron, I know, but long-term high, intermediate term high, because this high is lower than that one. But we have a swing high here and here that are lower, both being lower than this one. Then we have the same context right here. We have a high with a lower high on either side of it. So I have market structure behind me showing that this is, number one, it's a bearish market because my draw on liquidity is down here. It hasn't traded down there yet. Okay, so it's going to act like a big magnet. So all these fluctuations in here, without understanding what I'm showing you, it's going to feel like it's just noise. It's chop. It's not. It's actually telling you exactly what it's going to do. So the swing high here is an intermediate term swing high. So I want to be going short real close to this high because it's likely to break like it does here. So at 10:33, when it hits the upper end of that fair value gap, I have at this moment, go back one candle. We have this high, a higher high, and a lower high. So we have a high with a lower high on either side of it. That's a swing high. That is lower than this one. That is lower than that one. So it's far more than just, oh, he's just looking at lower lows, lower highs. That's what a myopic individual would come and watch this. So like when they see me put a rectangle on the chart, they're saying, oh, it's supply and demand. It's not. There's so many more factors involved that it's just not even in the same vicinity. Okay, so sparing all that, compare and contrast, because I've done a lot of that already on the videos on this YouTube channel. The elements of intermediate term, short term highs, I learned that from Larry Williams. Okay, that mode of deciphering market structure, he taught that in a video course that I bought back in the early 90s. And it was a video course that I mentioned many times in this YouTube channel, the Future Millionaires Confidential Trading course, something to that effect. It was 4 VHS tapes, and when he talked about market structure, it kind of went over my head the first few times listening to it. Like I didn't really understand what he was showing until I started literally going into the charts and saying, okay, here's a swing high, and this is how you learn it, okay? Because trust me, watching this video or watching someone else parrot what I say and then say, wow, he did it in 5 minutes, he's teaching it better. That's not, it's not jealousy me saying that. I'm telling you, you have no idea what you're doing. You're not even teaching it correctly, and those that believe that are learning it correctly are going out there and are wrecking themselves. What you're looking at is a price chart with a directional bias, okay? Something that's leading to a draw on liquidity. So I've already told you last week that we were going to go below that green line. That's where we were heading. So what you're doing is you're looking at all the swing highs. And every time you see a swing high, and a swing high is simply a high that has a lower high candle to the left of it and a lower high candle to the right of it. And the one in the middle, that's your swing high. Note that. Okay, in the old days, when we printed out our charts and such, and we had chart books delivered to us, we would get them once a week. They would give us the Friday's closing data and all the daily candles. And then, until we got our new updated chart book, we had to hand draw in the open, high, low, and close on the charts, on the markets that we were following. So, whenever we saw a swing high or swing low, we would just put a little ring above it, little circle, okay, like a little halo. And that would be a short-term high. Now, I would do a double circle or double halo for an intermediate term high, and then 3 halos for a long-term swing high. So that way, when I'm looking at price, it allows me to classify the level of high that it is forming. So it's not just lower low, lower high. No, you got to look at the nesting effect of the highs and lows. And again, that concept I learned from Larry Williams in the early 90s. He talks a little bit about it in his book, How I Made $1 Million Trading Commodities Last Year, which I believe is absolutely still essential reading, even though there's a lot of things in that book I think is just fluff and just like all the moon phases and things. I'm not into all that stuff. But his chapters on market structure and his $1 million trading concepts, those ideas and that premise behind it, they are still true today, and they probably will always be true. So if you don't have that book, my recommendation is to get it. Go and get it wherever you can. I'm not going to put any kind of affiliate links up so that way you can't think I'm making any money by shilling his books. I just think it's a really good book. And at least once a year, I go through it and read it just for nostalgia reasons. But I got it pretty much remembered verbatim. But by looking at that relationship of the highs, I trusted this because we had a swing high here already in effect. And I know that this candle here is not likely to go above this one because this one didn't go above that one and this one didn't go above that one. Not because it's lower lows and lower highs. There's much more going on underneath the surface than just lower lows and lower highs. That's just, it's cringy when you hear people talk like that and they try to reduce it down to something like that, or it's a support resistance idea. It's just buy the floor and sell the ceiling, okay? Or why doesn't ICT look at this trade over here and this trade? Because those trades are being referred to in hindsight by those people that talk like that. I'm literally taking live trades. I'm taking them, I'm executing on them, and I know why I'm doing it. I'm not guessing. I'm not trying to figure out or deciphering what it is after I get in a trade. I know what I'm looking for, and I know why I'm waiting for it. That is something that you learn by developing patience and trusting a model. The only way you trust it is to go through back testing. Look at all these price action moves and start classifying the swing highs and swing lows. I will amplify what I just talked about here on Thursday's lesson, okay? Because Thursday's lesson is going to be on market structure, okay? I'm going to teach a lot of people out there that think they know market structure. They don't really know that much at all, actually. But if this is the candle I'm trying to get in at and I execute on with all the understanding I just outlined there, I want to see displacement. We get it here. Now, if I didn't take this trade here, I could trade with the return back to this right here. Why? Why is that possible? We have a swing high. It's broken to the upside. This low is taken out here. This candle's high here. If it touches that again, I can be short there. Just using the imbalance in the fair value gap entry technique I'm teaching you. So I can go there and get short, or I want to get up here as close as I can to that important high that I've already outlined here. So I want to be in that and wait for that initial move, because then when this occurs, when you're that high up in the session high. So at 8:30, right there, this run up, I'm real close to this high by entering there. Notice that? I'm not waiting for a breakout below that low. So I'm getting up in there where it's an optimal entry. I don't need to get the highest high. You don't need to get the highest high. But you need to understand why it should be trading away from the levels you're trying to enter at. And that's kind of like what I'm showing you here. I'm hinting at a deeper lesson I'll give you on Thursday. But the displacement comes, which is what I was waiting for, and it gives you a confirmation. When this occurs, it's just almost like, okay, just sit back and just relax and just let it do its thing. Now, Monday, again, was a holiday. So I knew I had abbreviated session hours. So it's going to close at 1 o'clock. So that's right in here. And then the next candle obviously would be 1 o'clock, and it's not trading, so it closed. But it closed here ahead of 1 o'clock, and then the holiday session closing at 1 p.m. in New York local time, and the low, that green level there. Remember, go back to the daily chart at the beginning of the video and what we were referring to last week. The liquidity, the sell stops below this green line, that's where it was going to attack. Okay? and it came in and did so. It opened up 6 o'clock in New York time. It opened up and slammed down, accelerating lower. That is the move that you want to see, being short up here and covering down below here. Once it does that and it runs into low deep, that's it. You take your profits and move to the sidelines and then wait, because you have a big gap here. It's likely to come back and rebalance that and fill it in. And it does. And then ultimately trades around that old low and then eventually pumps up into the afternoon, consolidates, then goes into the early morning afternoon hours right there. And I showed how this set up, because after a big move, you don't want to trade in the morning session. Just don't do it. And I purposely go into a demo account to appease that desire to want to trade. So I don't burn the account. I don't take the heat off of a nice win and replace it or dampen it by taking a losing trade. In my history, in the last 30 years, I've been fortunate enough to know how I have hurt myself. And those things are the things that I like to mentor with, but those are also the lessons that everybody complains about until they lose money, and then they come back to me and they're like, I wish I would have listened. So I get it. You know, everybody has their own interpretation of what they should be doing, how they should be learning it, but you know, I've lived it. You're just now learning about it. So when I have a nice winning day, as you'll see, it was a nice little win. I'm not in a hurry to go back in. And then you have these days here where it can trip you up. You don't know what's going on. You don't know what's likely to occur. So I went in and I demo traded and used, again, quote-unquote discount broker leverage to compare and contrast those fellas out there that like to work in their market replay and paper trade their stuff with NinjaTrader, and then compare and contrast what I'm doing with TradingView. So it kind of like scratches an itch, and it keeps me out of trouble with a live account, because if you catch a good lick in the marketplace and you've had winning trades, or you caught a really nice winning trade that you had to wait for the setup to pan out, when that occurs, if you're new, you have an impulsive tendency to want to go back in immediately and get that dopamine hit again. I did something right. I made money. When I was a younger man, I did that, and I had some really nice run-ups in the account, and then, boom, I get a really big winning trade. And all of a sudden, I feel like it wasn't enough because I was solo. Nobody around me was supporting me. I had no support structure around me, none. I didn't have anybody saying, hey, what you do is awesome. You don't need to worry about it anymore. So it was just me saying I had to do more. So one of the mental hurdles you're going to have to contend with is knowing when enough is enough. And when you've made money, real money, in a live account, you just won't want to rush to get back in there again. You get folks out there that sit on social media and say, you got to push your edge. No, you don't want to push your edge, because if you keep pushing your edge, you're going to dull it. You sharpen it by knowing when to get in and when to get out, and you don't dull your edge. Okay, so when I hear people talk like that, I already know they're not profitable. I know they're not profitable because they're gamblers and they want to sound like they're doing something all the time, and they're not. And if they are, they're doing it probably unprofitably. So this morning, after 9:30, again, what's the bias? Bearish. That has not changed. Even though we had this run up, it hasn't changed. So at 9:30, equities open. After consolidation, it runs up, creates a high, and then runs up again, takes out the high. That right there is your run on stops. Wait to see if it wants to break down. It does. So we're going to look at that and refer back to the video. I just put a little short video up this morning and outlined the whole business there. I don't want to do it here because it's just rehashing what I already showed in a very short 1 minute or so video. But ultimately, right in here, we have a nice little selling opportunity. and you can attack the fair value gap in here between the low and the high. Right there it would be. And if you want to trade with the longer term bias, you could attack this sell side liquidity resting below here and here because they're relative equal lows. And then you would have got a nice fill there as well. So I teach in a manner that allows my students to pick, number one, the style of trader they want to be. They want to be a day trader. They want to be a scalper. They want to be an intraday swing trader. If they want to be a short-term trader where you're holding over to, overnight, or if you want to be a daily chart swing trader or 4-hour chart swing trader where you're holding for a week or more, or if you want to do a position trader, which to me is I don't have that mentality to do that. I have too many things that show up on a chart that make me change my mind all the time. So I have a lot more opportunities because I think short term and I excel in short term. That does not mean that is not a profitable way of trading when it's position trading. It's just I don't match that personality wise. So I like to excel where I'm strongest, and it's in intraday trading, and I can run the account pretty quick with velocity. I can get short-term moves, and just parlay them up real quick, which is kind of like what I was demonstrating, facetiously this morning with the 1-minute video, thumbing my nose at the quant. So we're looking at the likelihood of potentially going back down below that level again. If it does, it'll probably start to accelerate. I like 13,300 if we get, on a roll going lower. I like that one. And maybe even if we get really excited, we can trade down into the 12,000s. Okay, 12,850, 12,875 in that area. So just something to think about. I'm not suggesting you should take a trade in it or not, but just thinking out loud. This lesson obviously was a little bit fast and loose, and then we'll be a lot more structured on the market structured lesson on Thursday. Hopefully you found this one insightful, and I'm going to show you again. This was a trade I actually took with a live account. All right, so I'm going to log into my TD Ameritrade account, and I'll show you a result of a trade I took yesterday. I have not taken any live trades today. Again, this is just to show real executions are being done. I like to teach with a demo, but just to answer the folks that are just really hardline critics or just want to know, can I push the button? Push the button, ICT. All right, so here is the business for the last 6 days trading. And again, this account is just to show what I believe a student could do. Now, right away, look at this right here. This is not a losing trade. It looks like negative $2,700.55. What that is an adjustment by the broker, because at the time of settlement, when I closed the trade, it showed that I was up $4,920. And then because of their accounting, they were just showing that they were reflecting a gain of $7,675, which is not an actual realized result for me. It was them doing their administrative side. It's a broker thing. Trust me, I cannot do anything to make that happen. It's not me doing some funny money business. Okay, anybody that trades with live funds, they've probably seen this happen in their own account. So over here you can see the executions yesterday. I had a scratch where I got in a little too early. I was a little ambitious. And then in the second one, I wasn't sure if it was going to go higher or lower. And just to appease my curiosity, I threw a short in just to see what we'd get. Snapped against me a little bit. Not much, but still enough to get my attention, and I knew what I was looking for. So there's the short I just outlined in the previous portion of this video. Wrote all of that down, held for the gap opening after the reopen at 6 o'clock, and there is the close of the trade right there. Nice little dandy, $4,920 fixes the little pinch I took on the one trade earlier in the day. And the one scratch was nothing, it was covering costs. Okay, and again, there's the business there. That's the entry, and that's the exit. And there's no commission costs on the one above that. So you can see that was not a trade. Hope you found this insightful. Until I talk to you on Thursday, be safe.